Joining me now is Congressman Brad Sherman, Democrat from California and a member of the House Financial Services Committee, which will hold a hearing tomorrow on the recent bank failures. Congressman, thanks so much for joining me. I really appreciate it. I want to get your reaction to what you heard today. What was your key takeaway, and how will it impact what you ask tomorrow?
Well, the Fed should be attuned to interest rate risk, since they, more than anyone else, actually control the interest rates. Mr. Barr said that this was a classic case of bank mismanagement. He's right, but it's also a classic case of misregulation. He says that the regulators gave good advice to the bank that the bank wouldn't take. Well, he's not a consultant to the bank, he's a regulator. When the bank regulators give the bank good advice and they don't take it, it's time to shut down the bank or tell the bank to take the advice, or they will be shut down. And this bank could have hedged its risk on these long-term bonds anytime last year at substantial cost to the bank, and then they'd still be alive today. Instead, they didn't want to bear that cost. They wanted to take the risk that they wouldn't need that insurance, and they wanted to increase their bonuses, their earnings per share, and now they become a problem for the federal government.
So I hear you saying it is both, that it was mismanagement, but also the lack of regulations. I know, and I want to follow up with your comments about the Fed, but let me just talk about the regulations first. You proposed a number of regulations, including restoring some of the key Dodd-Frank protections that were in place, requiring interest rate stress tests, for example, closing regulatory loopholes, requiring transparency and accountability from federal bank regulators. What, if any, ideas do you think actually stand a chance of passing through Congress, if any?
I think that we're going to force interest rate resiliency testing on banks. I'm hoping that we're able to go back to stress testing the banks of between 50 or perhaps 100 and $250 billion. And we've got to get away from this crazy notion that whether you have a bank holding company or structure yourself without a bank holding company depends upon on that issue depends upon how you're regulated. It's a silly difference that shouldn't be decisive.
Just to challenge you on that point, though, Congressman, I've spoken to folks on Wall Street who say that, look, the issue is not slapping more regulations on medium-sized banks, that ultimately that would overburden those banks and punish them for what was essentially mismanagement by SVB. How do you respond to that criticism?
We had the tougher regulations of mid-sized banks in progress from right up until 2018, and we didn't have this failure. What's punishing mid-sized banks right now is the example of Silicon Valley Bank and Signature Bank. People are worried. People are, in some cases, taking their money out. That's what's punishing the mid-sized banks. We need to have certainly interest rate change stress testing of medium-sized banks. And as a result of those stress tests, it can't just be that the regulators give them advice. No, the regulators have to insist that action be taken. If you take the action, you shut them down.
Congressman, would a stress test have prevented this crisis? Was it not about having more liquidity?
Stress test your liquidity. If this problem had been caught a year ago and they had seen, hey, the bank has a problem, it's got to take corrective action, we wouldn't be talking about them now. That's what's supposed to happen. Now, if they did a stress test that left out the obvious test, I mean, if you test a building for earthquake and you don't test it for flood, and there's a flood, well, you didn't do the right kind of stress testing. Number one stress test has got to be interest rate changes, especially if you're the Fed, since you're pretty attuned to interest rate changes.
Since you raised the Fed again, it sounds like you disagree with some of their handling of the financial situation writ large. Do you disagree with their decision to raise rates?
There's two Feds in effect. There's the Federal Reserve you often cover. What are the interest rates going to be? There's also a Fed that was the primary bank regulator. That's why we're talking to Barr tomorrow instead of Powell. Powell spends most of his time focusing on what the interest rates for the country should be. whereas Barr's job is the chief bank examiner and supervisor and regulator of Silicon Valley Bank. And in his testimony, he outlined how they knew there was a problem. They told the bank to solve the problem. The bank didn't. And then they just sat there and they watched the bank not solve the problem.
Broadly speaking, though, what is your reaction to how the Fed has responded to interest rates and the fact that they recently raised rates?
I think the quarter point was the right thing to do. If they had gone zero, that would have signaled that, oh my God, the banking system is in such terrible shape that the Fed is unwilling to raise rates, even though we still have inflation. And if they had done 50 basis points, people would say, oh my God, can the banks handle 50 basis points? The 25 basis points was the Goldilocks. They handled that. And I think that their interest rate policy, while painful, because we have to deal with inflation and that's painful, is the right one. But the bank examination here was just awful. This was a failure to take the basic steps and a failure to compel the bank to take the basic steps.
Congressman, based on what you heard today, do you think anyone from Silicon Valley Bank should face criminal charges?
I think they should face a clawback of their compensation. And unfortunately, we're going to have to correct the laws. They provide for clawback, but they're designed to deal with situations where the bank holding company is subject to the resolution. In this case, it's the bank itself. There are too many loopholes in our clawback. No bank official should be able to keep excess compensation collected within 3 years of when the bank goes under.
All right, Congressman Brad Sherman, we will be watching very closely tomorrow. Thank you for being here.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.